Emotional Biases examines how emotions influence investor behavior and decision-making within the program. Emotional biases arise from psychological feelings, impulses, and personal preferences rather than from faulty reasoning or incomplete information processing. Unlike cognitive errors, emotional biases are often deeply embedded in human personality and are therefore more difficult to correct through education or analytical training alone. These biases can cause investors to deviate from rational portfolio management principles, especially during periods of market uncertainty, volatility, or financial stress. Understanding emotional biases is important because investor emotions frequently influence risk tolerance, asset allocation decisions, trading behavior, and long-term investment outcomes in both individual and institutional portfolios. One of the most important emotional biases discussed in the topic is loss aversion. Loss aversion refers to the tendency for investors to experience the pain of losses more intensely than the satisfaction of equivalent gains. As a result, investors may become excessively conservative or irrational when facing potential losses. Loss-averse investors often hold losing investments too long to avoid realizing losses while selling profitable investments prematurely to secure gains. This behavior can reduce long-term portfolio performance and distort rational investment strategy execution. Loss aversion also contributes to panic selling during market downturns, causing investors to abandon disciplined long-term plans in response to short-term emotional discomfort and fear. Another key emotional bias is the endowment bias, which occurs when investors place greater value on assets they already own than on comparable assets they do not own. Emotional attachment to familiar investments may cause investors to resist selling securities despite deteriorating fundamentals or better investment opportunities elsewhere. Endowment bias often leads to concentrated portfolios and reduced diversification because investors become overly attached to certain holdings. Closely related is status quo bias, where investors prefer maintaining existing investment positions rather than making changes, even when adjustments may improve portfolio efficiency. These biases may prevent timely portfolio rebalancing and hinder rational responses to evolving economic or market conditions. The topic also discusses self-control bias and regret aversion bias. Self-control bias refers to the inability to prioritize long-term financial goals over short-term desires or consumption preferences. Investors exhibiting self-control bias may save insufficiently, take excessive withdrawals from investment accounts, or abandon disciplined investment plans for immediate gratification. Regret aversion bias occurs when investors avoid decisions that may later produce emotional regret if outcomes are unfavorable. This fear may discourage necessary investment changes or cause excessive conservatism in portfolio construction. Investors may avoid selling losing positions or hesitate to invest during market uncertainty because they fear future regret associated with making incorrect decisions. Emotional biases have important implications for portfolio management and financial advising. Because emotional biases are difficult to eliminate completely, investment professionals often adapt portfolio strategies to accommodate client emotional tendencies rather than attempting to remove them entirely. For example, highly loss-averse clients may benefit from more conservative asset allocations emphasizing stability and downside protection. Advisors must also provide behavioral coaching during market volatility to help clients remain disciplined and avoid emotionally driven investment mistakes. Effective communication, clear investment objectives, and structured portfolio planning can help reduce the negative impact of emotional reactions on long-term financial outcomes and investment consistency. Overall, topic demonstrates that emotional biases are powerful psychological influences affecting investment behavior and portfolio decision-making. Biases such as loss aversion, endowment bias, status quo bias, self-control bias, and regret aversion frequently lead investors away from rational portfolio management principles and may reduce long-term investment performance. Unlike cognitive errors, emotional biases are rooted deeply in human psychology and are therefore more resistant to correction through education alone. Successful investment management requires recognizing these emotional tendencies and developing strategies to manage their effects. For CFA candidates, understanding emotional biases is essential because behavioral finance increasingly plays a critical role in client advising, portfolio construction, and professional investment management practice.